We're live. Hey, y'all.
Hey, y'all.
If all of your investments depend on the strength of the U.S. economy and the U.S. dollar, then your wealth is more politically exposed than you think.
Now, this isn't about panic. This is about protecting Black wealth from a system that has never protected us.
That's right. That's right.
Last Thursday, we talked about divesting from the U.S. dollar. That live stream is overperforming because people understand something fundamental has shifted.
Today, we're continuing that conversation, not with vibes, not with fear, all right, but with structure and a plan, not concepts of a plan. We're right. We're looking at.
I've heard that somewhere before.
We're looking at specific international ETFs that we are considering for diversification.
As you know, we are not financial advisors. We are financial educators. So these are not recommendations per se.
We're giving you a place to start, y'all, all right, by showing you what we are considering. But more importantly, we're going to explain to you how to evaluate them intelligently.
So tell me, what's your biggest concern right now? A, U.S. political instability. B, the dollar losing value. C, the stock market volatility. D, all the above.
Stock market was a little crazy this morning, y'all. It definitely was. So we're going to talk about that and a lot more. But first, we introduce ourselves. Hey, y'all. My name's Halisi.
And I'm Rick. Welcome to our Black Utopia.
On our channel, we talk about money, travel, and life abroad. We help folks who look like us, who are getting close to retirement age and forgot to plan, get your money straight so that you can retire on time or maybe even abroad.
And early ain't bad either.
It's not bad. It's not bad. All right, sweetheart. So what are we talking about today?
Today we're talking about Black wealth with a global strategy. Today we're doing 4 things. Number 1, why international diversification matters right now today. 2, the key ETF matrix explained in plain English.
I think you meant to say metrics.
Matrix. I got matrix on my mic for some reason. 3, the specific ETFs we're researching. And 4, why this matters for Black wealth in this political moment.
All right, y'all. So the question was, what are you most concerned about right now? Was it A, U.S. political instability? Was it B, dollar losing value? C, stock market volatility? Or D, all of the above? If you're watching from the future, hey, let us know in the chat which one that you are most concerned about today. For us, y'all, is D, all of the above. All of the above. All right. So we're going to get right to it. But first, if you're new to our channel, y'all might not know. Well, back in 2018, Rick and I got a wake up call, y'all. We were looking at our money and it looked crazy. But we did get our financial act together and we went from negative 22,000 in net worth to over 1.1 million. Yeah. And we can do that.
You can do it too.
You can do it too. All right. You can do it too. So if any of that sounds interesting to you, what do we need you to do? We need you to hit that like button, all right, so that you know every single time that we go, hit that notification bell twice so that you know every single time that we go live or drop a new video, as well as, I'm looking at this stuff and it just doesn't look right, as well as subscribe. I'm sorry, I'm trying to do 2 things at once, y'all.
You're changing it back to that?
Yeah, that's our color. That's our color, not the other one. I'm sorry, baby. I'm sorry. Anyway, subscribe. We know that more than half of the folks who watch us are not subscribed to our channel, okay? So don't be lurking in the background doing all that other stuff. Go ahead and subscribe, all right? All right, great. So why diversification is necessary?
For decades, Black Americans were told to trust the same system that has underpaid us, over-policed us, and underprotected our damn assets.
That's right. Now, that same system is so unstable, right? Both politically, economically, and reputationally. When one country controls your currency, your retirement, your stock exposure, and your political risk, that's not diversification, y'all. That is not diversification. That is concentration risk. Okay? So we're going to show you this evening, today. It's evening here, y'all. It's 10 o'clock here in Lisbon,
night.
Portugal.
It's night.
All
It
right.
ain't evening. It's night.
It's nighttime. Boa noite.
Boa noite.
All right. We're going to tell you, plain English, what we are talking about when we're talking about evaluating ETFs. And some of this stuff translates to evaluating individual equities as well. All right. But before we name a single ETF, we're going to talk about what you should know and how to evaluate them.
So ETFs do not have earnings
per se.
They own companies that do. So instead of EPS, which is earnings per share, we use proxies.
Right? All right. So let's talk about those metrics. The first one is, and look, y'all, we are going to put up a table with all of these metrics with the ETFs that we are considering. So what you might want to do is put a little note down, get your pen and paper, put a little note down so that when we explain what this means, you can put it in your own words so that you understand it when you look back at it, if you are not familiar. All right. So the first one is expense ratio. That is how much the fund charges you every year. All right. So if an ETF has a like 0.10% expense ratio, 0.10, that means you're paying $10 for every $10,000 invested. So 0.10, y'all know your math, right? That's 10% of 1%, 10% of 1%, or a tenth of a percent. That's what you're paying, $10 for every $10,000 invested. Obviously, the lower the expense ratio, the better. We have an index fund with an expense ratio of 0. We've yet to find an ETF that we like with a 0 expense ratio, but hey. Broad market ETFs usually have very low ones, though, like 0.03 to that 0.10, all right? Sometimes with sector and thematic ones, a niche, it can go up from, 50% or 0.50 or a half of a percent, all the way up to a full percent, all right? And so just to let you know, this is important stuff. It might not seem like a lot of money, but let's just say you have something invested over 30 years, right? With a 0.10 to, a tenth of a percent annual fee. For every $1 you've invested per year over 30 years at a 7% return, which is low, that fee alone can cost you $100 for every $1,000 invested. $100 for every $1,000 invested. It has a compounding effect, all right? So you want to be careful. Number 2.
So number 2 is dividend yield. How much cash the ETF pays you as income. A 3% yield means for every $10,000 invested, you receive about $300 per year before taxes.
For
example 12% total return already includes, in this case, the 3% dividend yield and assumes reinvestment of those dividends.
All right. So the total return already includes the dividend yield, what you're going to get from dividends. And it assumes that you're going to reinvest those dividends, not take a cash out and spend it. Okay. So if you don't plan on reinvesting the dividends, don't look at the total return. Do not look at the total return. Number 3, weighted PE ratio. Okay. This is how expensive the companies inside the ETF are on average. Okay. So PE, price to earnings ratio, tells you how much you must invest to earn a buck of profit. So a weighted PE of 15 means that you, the investor, will pay $15 to earn $1 from that specific ETF. A PE ratio of 38.25 means you're going to pay $38.25 to earn $1 from that investment. So obviously, again, the lower, the better. Is that what you said?
We found one that had a very high PE ratio.
We're going to show you. All right.
We'll share that.
Individual stock will have a PE ratio as well, but obviously it's not going to be weighted, right? For those of you who don't remember your basic math, when you weight something, it means like, say you've got something and one item A is 50% of that thing, and items C, B, C, D, and E are 10%, then that item A is going to be weighted 50%, and the rest are going to be weighted 10%, 10%, 10%, 10%. Obviously, it's not that simple in your average ETF, but you get the point, right? That's what we mean by weighted. The lower, the cheaper. Higher equals growth expectations already priced in. So if you have a lower price to earnings ratio, it does not mean that that stock is not valuable. It could mean that it's undervalued. Okay. It could mean that ETF is undervalued. If it has a high PE ratio, it could mean, does not necessarily, but could mean that the growth that the market expects for it to do is already priced into the price of the stock. Okay. So that's how that works. You have to decide how much money you are willing to spend to earn $1, and that should be based upon the fundamentals. And what are the fundamentals? We're talking about them right now. All right.
Number 4 is historical CAGR, compound annual growth rate.
Y'all have seen that. CAGR. All right. In accounting, we pronounce that CAGR. And it means, again,
I had to find out, y'all, because I know accounting. Compound annual growth rate.
Yep.
How fast this ETF has grown over time annualized.
Wait, we got to stop for a minute. We're assuming you know what an ETF is. Okay, so let's just stop right here. All right, because this is very important and it's not that complicated, y'all. All right, I'm going to explain it really, really fast. Most people know what a mutual fund is. Let's say the Halisi and Rick mutual fund. A mutual fund is just a product that owns pieces of a lot of other stocks of individual companies. Okay, it could be a total stock market mutual fund. It could be a healthcare mutual fund, a hospitality mutual fund, et cetera, et cetera. You get the point, right? An index fund is a type of mutual fund. An index fund is usually a lower expense ratio. Okay, that's very important, lower expense ratio. And they can do that usually because they don't have an individual monitoring that index fund day to day. It's monitored by an algorithm with a human being checking in periodically, sometimes weekly, sometimes monthly, sometimes quarterly. It just depends. The higher the expense ratio, we should assume humans got their hands on it more often. Okay. An ETF is basically an index fund that gets traded just like individual stock. Okay, so it has all of the good stuff of index funds. In other words, it's got a bunch of companies in there, and there's some automatic diversification depending upon what kind of ETF that you purchase. But the good part about it is that it is traded like a stock. So sometimes, like with a Vanguard index fund, you might need $5,000 to get into that index fund. But Vanguard might have a similar ETF, and all you need is $5 to buy a fractional share of that ETF. Okay, so that's what an ETF is. It's basically an index fund that is traded like a stock. All right, so the compound annual growth rate. How fast this ETF has grown over time annualized. So what does this mean in just plain old English, sweetheart?
This tells you how much your money would have grown per year on average over a given period.
Right? Why this matters. 1 year returns, what does that equal?
It equals noise.
Mm-hmm.
A 3-year return equals sentiment. 5 to 10 year of CAGR, strategy test.
Okay, so we want to look back to see historically how this ETF has performed, or if you're looking at individual stock, how that individual stock has performed. So for example,
a 10% CAGR means $10,000 becomes about $25,900 over 10 years. A 7% CAGR means 10,000 becomes about 19,700 over 10 years.
So you can see a little bit of change makes a big difference. A difference between 10%, right, and 7% can make a difference. All right. And how you do the math on that, it really is simple. It's 10,000 times 1.10. 1.10, right? Because that is 10%, right? 1.10 times 10, or to the 10th power, right? Because every year it compounds. You take the 10,000 times 1.10 for the first year, you get that money, then you add times 0.1.2. The second year, that's how you do it, pencil and pen, okay? And that's how you get those numbers. Small differences matter a lot over time.
A lot.
Right? They
Yes,
do.
they do.
So for investing,
international ETFs, that can sustain 7 to 10% CAGR over a full cycle.
they're doing their job. All right?
Mhm.
They are doing their job. Past performance does not predict the future, y'all.
No.
Especially in these times. However, it does inform us, and it shows us whether a strategy can survive real markets, okay? Because over the past 10 years, we know there's been up and down, up and down, up and down with the Great Recession, with COVID and everything else, right? We've got something to go by. Now, obviously, we're going into uncertain times, but some things do remain consistent. And we can look back 100 years during the Great Depression and then World War II and all the stuff and see over 10 years how the stock market did. All right. Now, again, history does not predict the future, but it can inform us. Number 5, total return, not just price return. Total return equals price change plus dividends reinvested. We talked about that. This is the real return you actually experience as an investor. What matters?
Yeah.
Especially for international ETFs. Many non-US markets return more through dividends than through price appreciation, which is kind of the opposite of your average US stock or your US equity, okay? So we do know, especially here in Europe, that the returns that we are used to in the United States may not be there.
Yeah.
But it still is going to grow probably faster than inflation, and that's what you need. So ETF price grows 6%, dividend yield is 3%.
Total return.
9%, y'all. All right. So assuming, once again, that you are reinvesting those returns. All right. Always use total return, never just price return. Or you are undercounting what the ETF actually did. All right. Number 6.
Earnings growth, ETF proxy. ETFs do not have EPS,
Or earnings per share.
But they own companies that do. So we use proxies. In plain English, are the companies inside this ETF actually growing their profits?
Are they? So common proxies include quality factor, a strong balance sheet, high return on equity, dividend growth. That means rising cash flows. All right. Historical CAGR, which we talked about consistently. All right. So for investing, if the underlying companies are not growing earnings, long-term returns will be limited, y'all. This is why cheap ETFs can still be a bad investment. All right. This is interesting. Number 7, max drawdown volatility. How much the ETF has fallen during its worst periods. You can find all of this information out on Yahoo. All right. On Yahoo Finance. We're going to show you our chart, which we got the information from like a Yahoo Finance. The information is on Fidelity, and Schwab takes a little bit more digging to get to than it does on Yahoo. We, of course, Morningstar, but that takes a subscription.
Subscription, yes.
We belong to Better Investing, and that is a nonprofit that actually started the club investment movement. And they've been around since like the 1940s, 1950s, and their tools are better than any of the tools on Schwab, Fidelity, Yahoo Finance. Seriously, the only thing is they don't tend to have index funds, but they do have ETFs. So, in any event, the maximum drawdown volatility, how much the ETF has fallen during its worst periods. All right. You want to look over the 5 years and see how bad it has actually gotten. Okay. How much did the price fall? and when things went wrong. And like COVID is a perfect example.
Yeah.
Like if something drops 50%, obviously that's going to require 100% gain just to get back to where you were before, y'all. All right. If it drops down 25%, it's going to have to go up 33% just to get back to where you were before. All right. So you have to see if they have been able to do that when things outside of their control affect their business. All right.
Mm-hmm.
So you cannot compound if you panic sell, y'all. We talked to somebody earlier who panic sold, and she lost a lot of money. I told you our investment portfolio returned 27.7% last year. That was our return. It went up 27.7%. And on average, over the past 5 years, our average is 20%. 20% return every single year. All right. So what we're looking for, we don't talk about panic sell. This metric is about survivability. That's what it's about.
And not bragging rights.
Exactly.
I mean,
exactly. All right. Number 8.
Geographic concentration, where the ETF's money is actually invested.
In plain English.
Are you really diversified or just international on paper?
So for an example,
an international ETF that is 40% Japan plus 20% UK is still highly concentrated.
Exactly. So no single country should dominate your outcome unless that is a deliberate choice, right? So don't think just because it's got international in front of it doesn't mean that it is diversified geographically. So you've got to check, all right? You've got to check. Assets under management, AUM. This is number 9, and it is very important, and we will show you why in a minute. Assets under management. This is for ETFs and index funds. How much money is invested in the ETF? In other words, is this ETF widely used and liquid or small and at risk of closure? So the general guidelines is that if it has $100 million under management or higher, there could be a closure risk. 500 million under management, more stable, right? But when we get to $1 billion, that's very stable, all right? That's very stable. And you will see that it's interesting because the PE ratio kind of like changes depending upon how much they have under management. It's very interesting, the correlation. So ETF closure is not a catastrophe. It's not catastrophic necessarily, but it is an unnecessary headache that you can avoid. And then last but not least, before we get to the actual ETFs that we're looking at, is number 10.
Okay, turnover. Often overlooked. How often the ETF changes its holdings. Our goal should be under 10%.
It's called turnover, y'all.
Turnover.
And it is one of the listings, all right? How often are they selling stuff and buying other stuff? What is the turnover of their bucket of companies that they own, right? How much buying and selling is happening inside that damn fund? Why does this matter?
This matters. High turnover can mean high tax drags, a higher tax drag, higher trading costs, less tax efficiency.
Right. Lower turnover equals more tax-friendly circumstances, especially in taxable accounts, right? In your regular brokerage account, etc. You don't have to worry about that as much in an IRA, right? It appears that the less under management, the more turnover. The ETFs we are researching for due diligence, not recommendations, all right? We're going to put this on the screen and we are going to keep it moving. Hopefully, y'all are getting what you need. Let us know if this information is impactful. Let us know if we are teaching you in a way. CAGR is CAGR, CAGR, okay? not CAGR, not KAGER, but that's how it's pronounced. All right, that is how it's
I think
pronounced.
those are the rims for cars. CAGR rims.
Are they?
Yeah.
Are they? All right.
Yeah.
Oh my gosh, that is I don't know about no rims, y'all. I do not know about no rims. I'm just gonna tell you that right now. Right now. But let me just reiterate, just for those of you who want that CAGR, all right? CAGR stands for, why can't I remember? Why am I blanking? Compound, here we go. Wait, where is it? I'm drawing a blank now. Like CAGR. Y'all, let me look and see where we are. All right. Hold on one sec. There it is. There it is. All right. So compound annual growth rate. Oh my gosh, why did I have such a brain fart?
You got all kind of things going to your head.
Go all kind of things, y'all. Right? I did go to business school. I should know this. I worked at a venture capital firm. This should be in Brett. But look, I haven't worked at that venture capital firm in like 20 years. I know the stuff hasn't changed.
I'm still trying to get EBITDA.
EBITDA. So EBIT and EBITDA. So earnings before interest, tax. So that's what that is, and amortization. That's what that is. And like that information is interesting and necessary, but in the big scheme of things, I don't think that we need to get that deep for ETFs on our first go round. Seriously, y'all. Seriously, okay? All right, let's get to the actual ETFs that we are looking at. All right, pull this up on screen. One sec here. We don't want to move. Wait.
Just click one of the full screen or something.
Okay, that's weird. Okay, y'all. We're using StreamYard, and I'm going to tell you, they used to have it say put up on stage when you'd have a slide or something. And now I don't know. I don't know. I guess you're just supposed to click it.
You got too many choices.
I guess you're just supposed to click it. All right. So what we're looking here is all of the things that we just told you, right? That we're looking at: the expense ratio, dividend yield, weighted PE, the 5 to 10 year CAGR, right? Total return focus, volatility drawdown, and why this particular one is on the list. All right. So the first one is Vanguard Total International Stock ETF. All right. The ticker is VXUS.
The broadest possible international exposure covers developed and emerging markets, thousands of companies, very low expense ratio.
The expense ratio, y'all, was what? 0.07. All right, so 7% of a percent.
Why it might work: this is the foundation, reduces U.S. concentration risks immediately.
Yes. So these are not in any particular order necessarily, but I would say that Vanguard Total International Stock ETF is probably the strongest one on our list so far. Okay. The volatility drawdown profile. The volatility drawdown profile. That's not what I meant to say. That actually should say what the turnover rate is. That's what those percentages are, the turnover rate. So I will correct that, y'all. If you're taking a screenshot, volatility drawdown profile should be that actually should be the turnover rate. All right. The next one is SPDR, SPDR Portfolio Developed World XUS ETF. The ticker is
SPDW.
All right. This contains developed countries only. All right. Excluding the US. So it's Europe, all of Europe, Japan, Australia, like that. All right. Probably G7 besides us. These are stable economies, strong institutions. This might work in your portfolio because it lowers volatility. It has a lower volatility than emerging markets, right? Which is included in the previous one that we just talked about. But it still exposes you to non-US ETFs and equities, or equities within the ETF, okay? So again, that one, and this one has a 3% turnover rate. You see under volatility, y'all. 3% turnover rate, not bad. Low expense ratio, not bad. PE, the weighted PE ratio, 15 to 16 bucks to earn a buck, not bad. The CAGR, it's a little low. It's a little low, but not bad. Okay. Again, as I told you, what I have found is that the ETFs, index funds, and stuff like that, that are mostly international, don't tend to perform as well as the ones, or yeah, I'm not going to say as well because that's not fair. They don't have as high of a rate of return as the US counterparts. Now, that could be because their markets are smaller today. However, if it's in euros, those euros are worth more than the dollars. So there's that to think about, right? If their primary trade is in euros or what have you. And then the other thing is I think that they have been a little bit more conservative and are not as caught up in these quarterly disclosures. These quarterly disclosures that actually make companies do stupid things. This was not the norm always. This was not the norm always. I believe that it started after Enron, but I might be mistaken, but like not wanting to let a company go a whole year or so before they disclose, especially publicly traded companies, right? Before they disclose all of their books to see if some nonsense is going on, like what went on with Enron, okay? The next one is iShares. MSCI International Developed Quality Factor ETF, ticker is IQLT. What does it focus on?
It focuses on high quality international companies, strong balance sheets, consistent earnings, and lower debt.
That's right. This one might work, okay? Quality tends to outperform during instability, okay? Again, this one, though, has high volatility. It's at 20%. And when I looked at it, it did not have like $1 billion under management. So even though the growth is good and all of that, I would not let this one be the foundation of my international diversification pie. It just has a little bit too much turnover for my comfort. Okay. So, but because it's got, a little bit stronger performance, I might still buy a little bit of this, but I would not allow it to be my foundation, not with 20% turnover. When they're turning over companies like that, it's not just a tax issue. It's like, okay, so what are you guys choosing that every quarter or year you are changing out 20% of your portfolio? See what I mean? And, and so with emerging markets, it's a lot of times this is going to be the case because they don't have the same kind of financial backing sometimes that some other companies may have, especially American companies. All right. So maybe that is why there's that 20%. But this is when you start looking under the hood. And so for beginners, this might not be a good place to start. The next one is Wisdom Tree Global ex-US Quality Dividend Growth Fund. The ticker is DNL.
It's internationally dividend growth with quality screening. Emphasis on rising dividends. Cash generated global firms. Why it might work, income plus growth outside the US dollar system.
Yeah. All right. And so this one again has a pretty high turnover rate, but it is thoroughly in emerging markets, right? Again, when you've got these emerging markets, there's an opportunity for extreme growth. But you've got to look and do your own research, see what your strategy is going to be, and see what your risk tolerance is, right? The older we are, the lower our risk tolerance usually is, all right? The next one is Schwab International Dividend Equity ETF. The ticker is SCHY. This is a high quality international dividend pay and plays high dividends, all right? Higher yields, strong cash flows. This may work if income diversification when U.S. markets wobble, all right? Income diversification as, I shouldn't say when, as U.S. markets wobble. Because if November 2026 doesn't go down, if we don't have an election, y'all, we are in for it. Okay. Do you hear me? All right. The next one is iShares, Emerging Markets Infrastructure. The ETF, that's the ETF. The ticker is EM as in Mary, IF as in Frank. This is
a physical infrastructure and emerging markets.
We're talking about roads, bridges, all of that kind of stuff, y'all.
Utilities, and transportation, and energy systems. Why it might work, infrastructure demand exists regardless of U.S. politics.
That's right. Okay. Again, this has a little bit higher of a turnover rate, but the expense ratio is okay. The growth, because emerging markets, because there's more risk, the potential for income growth is greater than some of our more safer. You see the first one, Vanguard, with a 6 to 8% growth, whereas this one is 7 to 10% growth. Okay. And then this next one, 8 to 10% growth. Of course, this next one does have a much, much lower churn rate or replacement rate, right? Schwab Emerging Markets Equity ETF. The ticker is SCHE. This is a broad emerging market exposure. Okay, we're talking about Asia, Latin America,
and Africa.
That's right. Higher risk.
Higher potential reward.
That's right. This may work because growth happens where populations are growing. And right now, the population in the United States is at net zero growth. Net zero growth. Thanks, Trump. Thanks, Melon Felon. Thank you. All right. Net zero. Net zero is never a good thing. It's never a good thing. So why this matters?
Because Trump didn't just damage the U.S. economy.
He damaged trust, y'all. Currencies are trust instruments. We trust that when we are paid in a currency, the value of that currency will be stable and will be able to be used for the foreseeable future, right? Markets are trust mechanisms, right? When leadership undermines trust globally, the rational response should be diversification, all right? Diversification.
So black wealth has never been protected by loyalty to one system. It has been protected by strategy.
Strategy, y'all. Make a plan. Execute the plan. Don't be like the Melon Felon talking about concepts of a plan.
You got a concept of
right? This is not what we're doing. This is not about abandoning America necessarily. It's about refusing to let one country decide our financial future, period, the end. If you need help, we have our financial freedom program for late bloomers, just like ourselves, people who learned later in life how to get their finances straight. Everything that we learned to go from negative 22,000 over 1.1 million is in it. It's called Beyond the Bling. It is in the information below, the description below. All right. Beyond the Bling. That is our financial freedom program. You can get on our mailing list to hear about the next side hustle challenge if making more money is your thing. All right. Our cohort already launched last week, so it's already too late for this one. We will launch again probably in the summertime, right after the meetup. If you want to come to our meetup during Juneteenth week, that information again is in the description below. We're not selling tickets yet. We'll be selling tickets shortly, but It's the 15th and the 16th of June. And then all of the ancillary activities that we will be doing around that date are on the website. That information is in the description below.
So Sunday, we'll go deeper into BRICS. BRICS stands for Brazil, Russia, India, China, and South Africa.
And the 25 other countries who have either signed up or become partners with the BRICS nations. We're going to talk about.
Yeah, and what's real, not fear-based.
That's right. So we will see you then. Take a screenshot of these ETFs. If this is a good place for you to begin your studies, all right? This is a good place for you to begin your studies, and hopefully we will see you on Sunday. We love y'all. We need you to share this information with your friends, all right? Share this information. There are too many of us that are afraid of the stock market. We sell when the market is down and we lose a bunch of money, and then we buy when the market goes back up. So we never, ever, ever have the luxury of time in the market. Time in the market is what has created the 20% return year over year over year with us. Okay. If you've got a 15% return on your investments, y'all, in the stock market, within 5 years, your money will double. 100,000 becomes 200,000, 200,000 becomes 400,000, and so on. Y'all, 20,000 becomes 40,000, 5,000 becomes 10,000 without doing anything more. There is no other way to get to wealth besides investing. You got to invest. You can't save your way to this. You can't pray your way to this. Believe me, we have tried both and it didn't work, because faith without actions, right, is not going to work. It's not going to work. We still have to do the work. If you need help, we got you. We'll see you on Sunday. Bye, y'all.